Martin from Secrets, the channel for learning about trading and investing. Welcome to Markets Next Week, the weekly stock market analysis show where we look at the charts, technical charts, and do the technical analysis and try to learn something from what exactly happened in the market from the previous week, and then also plan for a better trade for the coming week that's starting from August 21st, Monday, tomorrow, 2023. So if you're not subscribed, subscribe so that you won't miss out on. Simply share to your friends and colleagues and who you would think that may benefit. Let's get into the charts. The first is a weekly view of the indices, Nifty and left side and Banknifty on the right side. You can clearly see that there is a flat pattern, there is a cup pattern, there is a rounding pattern. Breakout has happened and it hit almost near to 20,000 in the Banknifty, much above the 46,000, and then it hit the resistance there and then has been retracing for weeks now. Right, so that's what you see there. So it's a breakout in the progress and nothing seriously has affected the last four weeks of downtrend. There is another weekly view of the indices, left side Nifty and right side Banknifty. You can see that market had moved nearly 20% from the previous lows in both indices and then hit the resistance at the above the Fibonacci 61% on Nifty and below that at 61, just below that 61 Fibonacci extension in the case of Banknifty. That's how it is, and now it's in a parallel channel, trend line parallel channels, and it is heading towards the bottom of the channel, the Banknifty, and still on the top in the case of Nifty. So it's a weekly view, with the price moving between the trend line on the medium term, and also show the Fibonacci retracement as well as the extension levels. We can clearly see. This is another view, daily view of what's happening. So this is the 20% rally, non-stop rally that we have been talking about, always maintaining the 20 exponential moving average, and then it has breached that few weeks back, and Banknifty also has breached that as well as the on the Banknifty also. So you can see that there is a head and shoulder, the breakdown that has happened already on the Banknifty and Nifty. It's a crucial point on the neckline of that head and shoulder pattern, and it's also within the parallel channels, trend line channel, and you can see all that we have. You can see the gap supports, multiple gap supports down there till the 100 to exponential moving averages, and Banknifty also as well as major supports from where the breakout really happened. So last week's move, if you see that, it's 4 days. One day it was a truncated week because of Independence Day, and 4 weeks it was basically trying to move up and then move down. So inverted V-shaped move that has happened while Banknifty was consolidating, absolutely consolidating on the almost the 4 days. Last 3 days especially, it's consolidating, and it retraced as well. Nifty also tried to move up and retraced as well, but it did not go to the previous. Yeah, it did make a new swing low and then breach that support zone there, both of them below the exponential moving average of 20, and managed to close above the 100 exponential moving average in the Banknifty. That's another view, and here we have the candlestick analysis we are trying to do. So it's a small body. You can see it's a 4th week of retracement on the weekly charts in Nifty and the Banknifty, and it's at a support zone, clearly a support zone from where the breakout happened. So it's acting as a resistance zone, previous resistance zone acting as a support zone now, and the bounce up from here. This changing polarities, possibilities there, and candlestick is it's bearish in nature, and it's small body, which is indicating indecisiveness on both indices. Daily charts are showing that it has been consolidating inverted V in the case of V shape in the Banknifty. So last candlestick, Friday's candlestick, if you see, you can see it's indecisive dodgy, while good recovery and consolidation, range bound moves, still a small body, is what is indicated in the Banknifty. So daily basis, there is some consolidation in the last 2-3 days. It's a support zone, major support zone, which is a previous resistance from where it broke out. Major support zone, and that's what it is. You can clearly see the head and shoulder patterns from the chart as well. So basically there is indecisiveness, there is volatility, there is taking support. All this is happening in the charts. Bond demands, interestingly, the expansion has stopped on the downside on the Nifty, and it's consolidation, but it's a bearish bias because it's less than 20 expansion, 20 moving average median, while the expansion is still there on the Bank Nifty. So it's more so Bank Nifty is more weak and it's bearish in nature in the short term. From the volatility point of view, Nifty is not very volatile. The expansion is stopped last week, and because a small body is formed on, and the contraction is what is happening. So sideways bearish bias and bearish bias on Bank Nifty. That's how it is. Bollinger Bands are talking about. Let's see the support resistance. You can see the channel that is long from the previous was breached. You can clearly see the 20 exponential moving 50 exponential. So closes happened about the 50 exponential moving average on the daily. So the first resistance, major resistance, will be to close above the 20 exponential moving average. So, right. So that would mean that 19651 would be the first zone of resistance. So until then, it can move easily. And above that, 19867 is net previous swing high, and after that, you have all-time highs and the rounding number 20,000, which is the resistance upside. Downside, the support will be 50 DEMA. If that is breached, then you have a gap support right below. Right. That right below is at 201. No, that will activate big support, and then 19200 also is 19,000 rounding numbers. No, exponential moving average one is at 18,859. So our supports 200 DMA is way down at 18,400. So not likely to go there. 18,850 would be a good support zone, which is a 100 exponential moving average also. So looking at supports down, it begins with 19,264, 19,200, 19,000, 18,850, and that's the zones of the support downside. So resistances would be 19,500, 19,651, and 19,867 and 20,000. Right. Bank Nifty similarly, the first immediate resistance would be to take away the 50 exponential moving average. So before that, you have a previous swing high. So you have 44,151, 44,500, 44,650, 44,850, 45,000 rounding number, 45,100, 45,650, 46,350, 46,500. That's how the resistance in the upside. Downside, the supports would be at obviously the 100 exponential moving average at 43,850. If that's breached, 43,850, 43,590, 43,360, 43,000 rounding number, 42,800. 4800 is with 200 exponential moving average. The breach of that will be crucial. Return to complete bearishness. So that's the support resistances on the Bank Nifty. Analyzing the momentum and the trend, using the RSI indicators and the ADX, on multiple time frames, on higher and the lower time frames. Left side you have the high time frames, so weekly. It's still bullish on the Nifty, slipped in sideways in the Bank Nifty. Alright, sideways on daily on Nifty, bearish on daily on the Bank Nifty. That's a mixed bag. So momentum, in all, if you can see that it's Bank Nifty is having bearish momentum, right, on the short term. Nifty is still not going to bearish momentum on the short term. Otherwise, Nifty is also maintaining the bullish momentum on the weekly charts, while Bank Nifty has slipped into the sideways. So it's mixed bag. So it's still not turned bearish, is all you can say. So trend, if you can see, it's constant to the bearish on the weekly, on both on Bank Nifty. So it's in the DMI 90 or the trend indicators are showing bearishness on both time frames, but bearishness on that just crossed over. Just crossed over is what we can see that in case of. So we are using the ADX. So overall, we can conclude that the trend has crossed over to the bearish zones in the short term, as well as the medium term, just crossed over in the case of weekly charts, also on Bank Nifty. But Nifty is the trend is not crossed over, although short term is bearish trend. So Bank Nifty lost substantial amount of momentum, and also has lost the trend in the medium term as well. But Nifty is relatively stronger and holding on. Although short term it's bearish momentum and bullish trend. That's a summon substance. The VIX actually was crazy. Right? It's 20% of up in the last 3 weeks alone. It's 12.14. It went to the 10.3 kind of level too. That kind of levels, historic low levels, and from there 20% and above spike has happened. And last week it was 5.4% of spike last week alone, and this happened with 10% upside spike and then 10% below spike. That's kind of volatility that we're speaking about at the major zone. That's a kind of fight between the bulls and the bear that's happening. So the fear and the greed indicator is spiking up. It's 20% in 3 weeks while the market retraced. Right. So market is falling and this VIX is spiking. It's normal. It's happening. Just started. So whenever it goes to the below 10%, it's some sign of a peak out, and that's exactly what has happened. Now it's still maintaining the low volatility regime. We have to keep a close watch whether it's going out of control above the 12 and getting into the 13 zones, and near to 15, then we have trouble. Otherwise, it should be fine. But still in the low volatility regime is what. That's about the India VIX. And open interest is bearish, not bullish enough in the case of options OA, and futures OA is showing long unwinding. People who are long is unwinding their positions one by one. That's a factor that's happening. That's bearish in nature. So August 24 option strategy is what I was talking about. Full coverage is not bullish enough, but not bearish. 0.81 and 0.76 is not. It's far away. It's quite far from the one above that's required to indicate any bullishness. So it's not bullish enough is what the options OI for the next week is by which showing. So that's what the open interest data is. So this is options for the next weekly expiry options levels. I'm still trying to understand. For the Nifty, it's 19,300 and 19,400. It's a very tight range. 19,200 and 19. So 19,200 to 19,400 is where the highest put and call support and resistance are seen. So the second level of support and resistance is 19,200 and 19,400. So not very wide range. It's narrow range, as in par with what the chart is saying. So Banknifty, look at this. That's where the trouble is. 42,000 is where the highest put rating is. And support is for 42,000. Now it is at very close to the 44,000. So 2,000 points nearly. And 44,000 is where the highest. So 44,000 is a big hurdle as seen by the option writers in the bank. And a very wide range of down move is anticipated by the option writers. Second level highest put and call rating is at 43,500 and 46,000. That's also a wide range towards the upside. So that's how it is. Right? Rest of the information we already seen. So maybe a lot of these levels correlate them with the charts are seeing, and then you can it can help you to find the support resistance zones easily. Moving ahead, we are trying to analyze industry sectors and IT sector. So here we have some troubles that's popping up. Right. So now, except the pharma, none of these sectors are eligible enough to take a confident long positions, because if you look at the momentum perspective, on both the time frames of medium and short term, because the IT went down, metal went down, right? Pharma went down, FMCG and auto slightly flattish moved up, but realty also went down. So across the sector, sideways movement has started to happen. None of the sectors are bullish except the pharma. Let's say some in substance. So none of them are really to the bearish zones, right? Neither in the short term nor in the medium term. So that's pure sideways and some in substance. Let's try to analyze. Left side IT at resistance, momentum at resistance, price at resistance, consolidation on the top of that consolidation box. Metal, retracing after hitting the all-time high resistance levels. Momentum is bullish though. Medium term we are talking about. Auto at the all-time high retracing, intensive dodgy, bullish momentum. Pharma, bullish momentum at the all-time high levels. FMCG, bullish momentum at the all-time highs. Bullish momentum. Reality, bullish momentum at the all-time high. So it is normal retracement, nothing much has happened to the sectors which were leading it. Which were the sectors which were leading it? FMCG. The rally was led by FMCG, auto, reality. They are still bullish on the medium term. Pharma is also bullish, and pharma is bullish on both time frames anyway. So nothing much has happened in the medium term, right? But at the same time, short term, if you see, things are kind of not eligible enough to take the bull positions because of the short term moves. That's our summaries. Now we analyze the industry heavyweight stocks that contribute maximum to the index. Beginning with the HDFC Bank, it has been consolidating sideways, zigzagging in that box, flag and fall, unable to break out of that zone, still remains sideways falling trend, moving towards the bear zones, but still bullish. On the medium term charts we're talking about, right? So HDFC merger and all these things, it takes time, but eventually it is going to break out, is what I would look at, unless because it has been consolidating very long, and fundamentally also it's a strong stock. So lens, good volumes at the top of the channel, about to break out, green show. HDFC Bank at the top, all-time high, takes support of the neckline of the cup pattern. Momentum is still bullish, so absolutely no problem with the lens and HDFC Bank. Infi cleared one of the gaps and then trying to move further up. Momentum is still rising, but sideways still. TCS also momentum at resistance, unable to move up at resistance. Korak Bank, as usual, it is moving up and down within that range. ITC is tracing after a mega breakout of the long cup handle, and it's tracing, probably it may move to the 367 400 kind of zones where the support of the neckline is there. Momentum is still bullish. So ITC, so momentum is bullish for ITC, Reliance and ICICI Bank. Others are all sideways. So these are the stocks that's still having bullish momentum in the medium term. So that's how the industrial top 7 critic stocks are performing. In a nutshell, we have leading stocks that's driving and holding the market. As long as they are not turning into bearish zones, things should be fine in the medium term. Institutional participation, once again, Fyers have been selling for the 4th consecutive weeks, 3,379 crores of selling in the cash market. Domestic institutions, was finding opportunity to buy. At the same time, nearly 4,000 crores of buying has happened. Net longs in derivative section also moved down last week. So institutional participation, Fyers is not buying, is a buying for 4 weeks, is a buying. Right? Very few greens in between. Fyers seems to be selling. Right? That's what happens when retracement and pullbacks happen. Now, we're trying to analyze the global markets, commodities, and currencies. Let's begin with the currencies. The dollar index is spiking up. It's a cup and handle, breaking out of that handle, and then on 3.43, it's 0.55 up, right? And 15% down is all over, and it's breaking out. Right, but still in the moment it's sideways, not climbing the bullish zone again. USD INR currency pair is 0.32% up. That's where the trouble is. 83.12, and look at the weakest level, right down here. It's trying to break out of the all-time high. Some RBI intervention kept that on hold, but bullish breakout from the ascending wedge is what is happening. This is worrisome. Rupee is getting back to historic peak levels. Gold, before that, the crude oil has met with some resistance at the top of the channel, so relief. Momentum has met with resistance as well, and fallen and slipped to the sideways. Gold, on the other hand, is also falling, crashing. 3 weeks of wide range bearish candles, momentum is sideways. All of a sudden, this trend is closed down in the medium term. So gold is not finding bias due to some risk. Right. It's a hedging instrument that may be buying opportunities. Market that may also be closed. The market may eventually may not be crashing, and it may be just a small correction that's happening. Since if the market is going to crash, then people would have shifted to safer havens, which is not happening in gold. Right? So that's about commodities. And moving ahead to the US market, the mother market indices. If you see, the Dow Jones is having it's a red 2% red close in all the major indices. Nasdaq, S&P 500 and the Dow Jones all right. Momentum has slipped to the sideways from the bullish zones. It is met with the resistance and all on the descending wedge top. Bullish momentum is was maintained since last week, until last week, and now it's slipped in the sideways again. So huge resistance at seen clearly visible on the charts. That's a worry, right? It's 2.25, 2.1, 2.3% respectively on the Dow Jones, Nasdaq, and S&P. So it was attempting to break out of that, face the resistance while trying to break out. That's what US markets shows. Moving ahead, we have two actionables. GMR infrastructure is having a very long multi-year rounding pattern, and it has already broken out with a solid bullish candle. With the tight stop loss below that, you can have long opportunities. Volume is good, momentum is good, bullish trend. Second, Lupin Pharma is only sector that's bullish, and it's a rounding pattern breakout that has happened already and can be rewarding till the all-time high. With the tight stop loss below the breakout candle from the cap pattern. Volumes are decent enough, above moving average, and momentum is bullish on absolutely. Some retracement pullbacks could come in. You can see that as a buying opportunity with tight stop loss. Trend is also bullish. So, two picks for the next week: GMR infrastructure long and Lupin pharma sector long positions. Another action for the next week is the pair for the Nifty options weekly momentum strategy. This is the usual strategy, very simple, consistent, good probability of profit, decent range, decent risk reward, and low margin requirements, completely hedged, risk defined. And it's basically selling put and call options of far OTM and then taking further far OTMs as hedge positions for the in the for a week, right? So double diagonal calendar split. So you have the advantage of the volatility spikes as well, since the VIX is very low. You have the advantage of that. The only thing is you should not wait till the expiry day. You should get on one day before that, or 1 to 2% target every week constantly. So I could not find any other strategy that gives a better range. Look at the range, 19,000 to 19,500. No other strategy gives that unless you take substantial risk of keep on spending money on adjusting and making the broker rich. So that's why I keep coming up with the same strategy. It works most of the times, right? Adjustments, of course, if it breaches that range, that wide range that we have, it breaches, if at all, you just have to roll up and roll down, or basically move the hedge positions as well as the selling points further on the opposite side when the market moves in one direction, right? Now, just wrap up things, and what we are seeing is a fourth week of retracement, fourth week of red bearish candles. 46% of correction has already happened in the indexes, and market has retraced and consolidated as well. And this, remember, has happened after meeting the resistance at all-time high levels after a rally of nearly 20% on both indices, breaking out of the cup and handle flag pattern. That's the story. Now we have bearish candle patterns. We have a slip in the momentum in the trend. We have long unwinding and not so bullish enough open interest on options in the futures. And foreign institutional sellers, selling is continuing for the 4 weeks, and Bollinger Bands are having bearish bias. US market is showing red and resistance. All this definitely gives bears a hope for a further sellback or bull retracement consolidation that could, bears can hope for that. What does a bear have? What does a bulls have? It's a change in priority, support zone where the market is consolidating, and a very crucial zone. It's a zone where the previous resistance would act as support, and then bounce up from here happen. That's all I hope. 46% of correction is not a big deal, when market is at a very big rounding numbers like 20,000. So profit booking obviously will come in, and that's what is happening. 46% after 20% is not big enough. Hope it does not go beyond that, beyond 10. So you can keep watching the Fibonacci extension, Fibonacci retracement, all that levels too, and the support resistance levels that we talked about, to keep a close watch on whether it's going beyond a normal correction or not. But overall, given that what the charts are saying, it's a mild bearish view that I have. The global recession fears and all this interest rate war, all this uncertainty is still there. Crude oil is it's spiked up and got reversed. Rupee is at extremely low, weak level, which is a concern. So all this can cause the VIX to spike up and take us out of the low volatility range where we have to be extremely cautious. So for the next week, 18,800 and 19,600 is the range for the Nifty. 42,500 and 45,500 is the Banknifty range that I look forward. So as long as the 18,800 and 44,000 is maintained somehow, then there is a possibility that the correction can cease, some bearishness can turn to some consolidation in the Banknifty as well, and then further up move can happen from there. Right? If that's breached, then we have a longer correction is what we would anticipate. Right? We cannot predict anything exactly as we think. We can only see what the charts are saying and then try to look at where the possible resistances are there, where the possible supports are there. That's all in our hands. Rest is all risk management, cutting short your position, scaling up your positions, managing your risk, and having stop losses. All that's in our hands. Now always take hedge positions if you are taking overnight, because a black sand event can swipe away all your profits and capital as well, and then you are no longer in the game. So in order to stay in the game, have that risk defined positions, non-directional strategies that we have been talking about. Our playlist has a lot of strategies that helps you to do trading based on the options with defined risk. Also, it can be used for hedging positions. Also, it can be used for getting rental incomes like option covered call strategy and all those different cash secured puts and all that. Check out the playlist and you can see a lot of videos on that apart from the weekly analysis that we do. I hope this video has brought in some clarity on what action plan can be, trade plan can be made from the text screen. If it has helped you in some way, consider hitting the like button, and if you're not subscribed, please subscribe right away and then share to your friends and colleagues. Appreciate the help in this regard. And if you want to avail Telegram channel service, paid services, you can click on the link as well. Also, we have the social media throughout the week before this weekly analysis come. Throughout the week, we keep on posting technical analysis and educational content will be available on this channel. So please subscribe to these as well. So thanks for watching. Happy trading, happy learning, happy investing. Bye bye.